In the growing tensions between the RBI and the government, there has come a new topic in the picture, that is the interim surplus. Today at Indian Folk, we shall throw some light on the subject. How does a central bank like the Reserve Bank of India make profits? The RBI not only keeps inflation or prices in check, it also manages the borrowings of the Government of India and of state governments, supervises or regulates banks and non-banking finance companies, and manages the currency and payment systems. While carrying out these functions or operations, it makes profits. Typically, the central bank's income comes from the returns it earns on its foreign currency assets, which could be in the form of bonds and treasury bills of other central banks or top-rated securities, and deposits with other central banks. It also earns interest on its holdings of local rupee-denominated government bonds or securities, and while lending to banks for very short tenures, such as overnight. It claims a management commission on handling the borrowings of state governments and the central governments. Its expenditure is mainly on the printing of currency notes and on staff, besides the commission it gives to banks for undertaking transactions on behalf of the government. What is the nature of the arrangement between the government and the RBI on the transfer of surplus or profits? The RBI, unlike a commercial bank, does not as such pay a dividend to the owner out of the profits it generates. Although RBI was promoted as a private shareholders bank in 1935 with a paid up capital of rupees 5 crores, the government nationalized it in January 1949, making the sovereign its owner. What the central bank does, therefore, is transfer the surplus, that is the excess of income over expenditure, to the government in accordance with the Section 47 of the Reserve Bank of India Act 1934, after making provision for bad and doubtful debts, depreciation in assets, contributions to staff, and superannuation of funds. Its statute provides exemption from paying income tax or any other tax, including the wealth tax under Section 48 of the RBI Act of 1934. Why is the transfer of surplus significant to the government? The quantum of surplus transferred over the past few years has been large. In 2015 to 2016, the RBI passed on rupees 65,876 crores, which formed a sizable chunk of the revenue which the government earns under the hedge of non-tax, which is mainly dividends. This was much more than the surplus generated by banks and other companies owned by the government. The quantum of RBI transfers has in fact been rising progressively and has helped the government narrow its deficit of borrowings. That is why the halving of the 2015-16 surplus this year from rupees 66,000 crore to rupees 31,000 crore has raised concern in the markets over the possible impact on the government. Now, why was the surplus lower this time? The reasons that are being given are the possibly lower returns on the RBI's overseas investments due to low global interest rates and increased costs on account of liquidity management. And especially after the demonetization exercise of November 2016. The surplus available will also be lower if the RBI has made provisions to set aside some funds for specific purposes. Now, how does the government build this surplus into its budget early in the year, and is there an explicit policy on the distribution of surplus? Well, before the annual budget is unveiled, which is brought forward to February 1 this year, senior RBI and government officials discuss the likely amount which could be transferred. Typically, the government pitches for a higher share of the surplus, while the central bank sometimes prefers to set aside funds for contingencies. Besides, on these stocks and calculations such as likely income and earnings, an indicative figure is given to the government, which it puts under the head non-tax revenue in the receipts budgets. As far as the policy measures of the distribution of surplus is concerned, a technical committee of the RBI board headed by Y.H. Maligam, which reviewed the adequacy of reserves and surplus distribution policy, recommended in 2013 a higher transfer to the government. But there is no explicit policy as such. Earlier, the RBI transferred part of the surplus to the contingency fund to meet unexpected and unforeseen contingencies, and to the asset development fund to meet internal capital expenditure and investments in its subsidiaries, in keeping with the recommendation of a committee to build contingency reserves as 12% of its balance sheet. But after the Maligam committee made its recommendations in 2013-14, the RBI's transfer of surplus to the government as a percentage of gross income shot up to 99.9% from 53.40% in 2012 and 2013. Now, does the RBI and the government agree on this? the government has held the view that going by global benchmarks, the RBI's reserves are far in excess of prudential requirements. Chief Economic Advisor Arvind Subramaniam has suggested that these funds to be utilized to provide capital to the government-owned banks. The central bank, on its part, prefers to be more cautious and build its reserves, keeping in mind potential threats from financial shocks and the need to ensure financial stability and provide confidence to the markets. From central bank's perspective, bigger reserves on its balance sheet is crucial to maintaining its autonomy. How do other central banks manage a transfer of surplus? Like in India, central banks in both the UK and the United States decide after consultations with the government. But in Japan, it is the government that decides. By and large, with a few exceptions, the quantum of surplus transfer averages around 0.5% of the GDP of a country. If you like our video, do share it with your friends and do subscribe to our channel as well. Thank you.